Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to accomplished UK fund manager Richard Staveley of Harwood Capital, who runs the Rockwood Strategic Investment Trust. So, massive welcome, Richard.
Thank you very much, Paul. Great to be back.
And
thanks to everyone who's tuning in.
Yeah, well, very big congrats too on all your sort of like investment returns over the last 1, 3, 5 years, and even 10 years. As I'm just looking at the actual chart of the Rockwood Fund, you've sort of like 4-bagged, I think, over the last 10 years or so. So terrific performance. Now, maybe we can start there. I don't suppose you could just quickly or briefly remind investors a sort of secret sauce behind the investment trust's incredible success.
Yeah. So just firstly, just so that we don't get any off on the wrong foot, I started managing the fund in late 2019. So I don't want to claim before that was me, but it has been a good 5 years now. It's, without a doubt, I think we are number one. So that's great. I think like any kind of the factors that create great investment returns, there is a bit of a secret sauce. I think something like Lee & Perrins has apparently 8 ingredients, and the key is that they all do something for the outcome, but you definitely don't want to sort of change the mix. And I think consistency about our approach is one of the key things. So what are they? I think the first is like focus. So we only have 23 holdings. In fact, one of them's currently in a bid process. We'll have 22 holdings in the next few weeks. A lot of funds, Aberforth actually had their results this morning. Very good value manager. 79 stocks they have in their portfolio. We just 22. And that concentration means that we have a lot of time to focus both on the businesses after we bought them, monitoring them, engaging with them actively, but also we've got extra time to due diligence, just buying just a small number of stocks each year rather than always trying to find lots and lots of new ideas, and hence have a lower hurdle rate. I think the second thing is that our valuation bias, it's one of God's great gifts. We genuinely think very carefully about, are we getting into stocks which are genuinely cheap on a free cash flow or based on their assets, and then accompanying that is a real need for patience. So a lot of people kind of want to be value investors but can't be patient investors, and if you don't have the both, you end up in trouble. I think we also, there's no doubt, if you look in the last few years what's driven the performance of the fund, in the individual stocks, we have got a heavy bias to recovery situations, not exclusively, but that element of finding companies which we think are down on their luck, their performance, but have the scope for turning it round, can produce material returns from both the re-rating and the recovery of the profits. And it's that style investing, I think, is what we're seeing is proven. Final bit is just the active piece, where we do get stuck in. So we're on the boards of a number of our holdings. We agitate for things that are going to catalyze share prices. And you'll be well aware there's lots of individual investors I'm sure that you speak to regularly and enjoy watching Vox Markets. They just go, why does this stock nothing happen? Why does it's so completely the wrong price? And that, getting those things catalyzed sometimes does require a third party, an external shareholder, to do. Otherwise, things don't change. So those would be the key aspects. I think just finally, returns, as you said, have been strong, but just it's really important everyone remembers our target returns are 15% IRRs over rolling 3 to 5 year periods. And actually, our 5-year return is TSR is 114%, and 15% a year over 5 years doubles your money. So we're kind of over the 5 years. Last year we did over 25%. So that was a really strong year for Rockwood. I wouldn't want people to start thinking that's what we should get every year from Rockwood. But if we do 15% a year, we will be top of the pops. So that's what we do. And underlying that, that's our target, because when every stock we buy for the portfolio, we are unashamedly, we are not interested in making 50%, seeing something's going to have some good news and go up 10%, stuff like that. We're looking for stocks that can double in value, minimum 100% upside over a reasonable time horizon of 3 to 5 years. And I think that mentality is also differentiated from many investors.
Yeah, well, I have to apologise actually, Richard, because I cheekily asked a few of your shareholders yesterday. I polled some questions, and we had one from who's a Rockwood shareholder, Honir, and he says basically, obviously Rockwood are an expert in all things turnaround and recovery stock. Is there a danger that you sort of like look for the biggest challenge to get on the board and to change it around? Is there any sort of like any danger of that at all? The risk to the portfolio that you pick something you can't really sort of, it's a bit too much of a problem child.
There is no doubt that we will get things wrong. That's part and parcel of being, an investor of whatever experience or professionalism. And the onus is on us to try and work out, are these businesses recoverable? We have one stock in the portfolio at the moment where I would suspect that 99% of investors think we've taken on too much in Capita PLC, which we may talk about later, and they may be right. So we have to, there's a point at which you go, actually, the business can't be turned around. That said, usually with investing, the only time where the downside is really bad in those situations is if you've got a balance sheet problem. And that's where our DD focuses. So often it's really the time it takes to eventually sort something out. So the IRRs get kind of compressed because it's taken too long, rather than this can't be turned around at all and we lose all our money. So I think leverage is something that we're very carefully think about.
Yeah, okay. Well, let's move to Capita then, because we do actually have 3 people who are asking about it. We have we have Ben Sharman, Spooner, and Simon Monk all saying, this is basically a very well-known British outsourcer to the public and the private sectors that have some sort of iconic contracts. I think it used to do the sort of like the congestion charge in the UK, but Still does, yeah. It does some really iconic. It's been through some trials and tribulations, and I think it's on a sort of like a strategy to shrink to then eventually grow, and particularly grow those operating margins. What's your latest on Capita?
Yeah, so there's no doubt we had a kind of quite a disappointing update from them at the back end of last year. There'd been some fantastic news earlier in the year in that they'd sold off one of their software businesses called Capita One for 180 million. And that had really repaired the balance sheet very, very significantly. Just to remind anyone that hasn't followed the story, the previous teams who had basically gone on an M&A spree had ended up with leverage at over 3.5 times net debt EBITDA. I mean, in full crisis zone. They've been disposing of businesses for some time now to try and get the balance sheet in shape and to focus the group. That process is pretty much finished with that last one. I think they've got a couple of small things that might go, but the management team tell me there's nothing left of real consequence to dispose of in the group. The trading was quite difficult. Now, I'm trying to avoid getting into Westminster, but Rachel's national insurance contributions change is not helpful for a company like Capita that has tens of thousands of UK employees. So that was a 20 million hit, which they've had to take on the chin. So in the back end of last year, at the same time, trading had been relatively soft, particularly in the private sector focused outsourcing. Now, where we are with it? Three things. Firstly, the public sector piece, which is about half the business, actually its revenue fell 1% last year, and they do the congestion charge, the student loan company, the TV license, very strong incumbency positions in solid solid contracts. It's the other half, which is the sort of to the private sector, where they have a range of customers from telcos to banks, which has been struggling. They've upgraded. There's so much cost they can take out. Adolfo Hernandez, who's gone in to sort this out now, and appointed a new head of transformation, a new CFO. He upgraded on the NIC things, the cost savings at Capita now to 250 million quid. They are doing a 250 million pound cost cutting program. The market cap is 240 million. This business has 2.4 billion of sales. So for those that are, this is too difficult, and the rest of it, the prize is to get that 2.4 billion of sales with a margin of 6 to 8. That's what they're targeting. This year, they'll have done about 4. So basically, they think they can get profits up about 50% on the minimum on the 2.4 billion of sales. The other big problem has been its free cash flow generation, which has been terrible, which they're trying to get sorted, and they are getting gradually sorted. But that's the key, and that we only think they'll get there in 2026. So again, for the patient investor, by 2026, they should be delivering. We think that they should be able to generate in a normal year in excess of 80 million pounds of free cash flow at that point. So it could easily. People will be looking at this. There are a lot of international businesses in outsourcing. They've got some very nice contracts, and I think, as you mentioned, the spot multiples are low, but free cash flow has to improve. There's one piece we're looking for that could catalyze the shares this year, and that is they have one business that does like closed life and pensions activities, and I've had it for some time. It's burning lots of cash because it's not on the right level of scale. They've only got 2 or 3 evergreen contracts, which they sort of have been a bit stuck in, and they're burning about. It's not fully disclosed, but we think about 20 million of free cash flow out. But because of the accounting on that, they have to book a profit of 5 to 10 million in the profit. So the delta, if you got rid of that or stopped doing that activity on free cash flow conversion, would be very significant, and that's just a key catalyst that we're looking for this year. And we've engaged with the company on that. We think they completely understand that problem needs to be solved sharpish.
Yeah, and will the AI sort of like, if you implement AI, presumably that will help its cost base?
Absolutely. Well, this is the thing. The Adolfo has just come from being head of Amazon Web Services in Europe. I came across him first in a previous business which I was invested in called SDL, which he came in to sort of sort out and then got taken over. So he's a senior man. He's a management guy, but he's a kind of he's a technology guy. And I think contact centers, if you think just on literally all basics, contact centers have gone from lots of people, let's face it, in Sunderland, in huge things, on the phone, working from home. Does it need to be in the UK anymore? The level of tech that can automate and speed up that process, make those people much more effective, is all something that they've been, because of all the other problems, have been quite slow to put into the business. So that's why he's finding the cost savings. The other thing that's sort of relevant to the equity story is that he's also inherited huge swathes of offices that they don't need. So they're dropping the lease bill by about 10% a year at least. And that's getting down. That's a cash flow. That's obviously a cash flow drain that will come out of the company gradually as well. So we can see a pathway to much better free cash flow conversion. At the point that this turns to being acceptable for normal investors to look at, people are going to absolutely, they're going to be the mainstream professional investors will be fighting over to get the stock, because when you've got 2.4 billion of sales on the march to normal levels of profitability, the market cap could go up a lot, and it will be a big index problem for them if they're not owning some shares.
Yeah, no, it'll definitely be a moment that you want to own some stock. Okay, let's move to another.
3.5% in Rockwood, in it. 3.5% of the portfolio.
Okay, well, one which has done really well for you. Let's move to Filtronic, which has literally gone to the moon over the last 18 months when you first talked about it. What's your latest on this? We had a couple of people, Viz, and we've got Peter Minion asking you to say a few words.
Yeah, so it's been fantastic. It's based up in Sedgefield, Tony Blair's constituency. They make pieces of IT hardware kit that essentially go into defence, into space markets and telco markets. They're world class. They're extremely brainy, and it's all radio frequency applications. And what's really transformed the business is the need for the Starlink satellite network that SpaceX owns to be able to send with low latency, very, very quick data to their satellite and to offer this internet service around the world. And Starlink tried to solve the problem of going up the wavelength to speed up, and they couldn't do it internally. Filtronic solved the problem for them, and they've given them these contracts, which have so far only gone into the ground stations to beam up the signal. Why that's interesting, because wherever they are, despite it doing extremely well, is that they haven't yet actually won any contracts to go into the actual satellites. Also, they haven't actually, although they did do a little bit of work actually with Facebook a while ago, a number of years ago, because they were looking to a thing with balloons, which had the same issue. They haven't actually signed any other or announced any other material contract with anyone else who wants to put up a low Earth orbiting satellite network. And there are lots of projects of people trying to do it, not least Jeff Bezos, who's got one called Kuiper that he wants to put up with his, and he's got the same problem that they're all trying to solve about how do you do the data, which Filtronic has solved. So their potential for further significant growth in contracts is very, very material. I have to say, we bought the shares at 12p. Musk took warrants in the stock at 33p. I think this morning they hit 99p.
Yeah, they're quid. They're a quid.
Could be Rockwood's first 10 bagger if we get to £1.20. So that's a super exciting thing to talk about as someone that loves markets and loves investing. Now, what could go wrong? Well, actually, not much quite right now. They've got net cash. They've just done another massive upgrade. Now, just about the upgrades with Filtronic. So get this. This is great. So they've just upgraded 25's turnover number to 48 million quid, right, for Filtronic for this year. 2026's forecast revenue currently in the market is 41 million quid.
Wow.
The current market expectation is that Filtronic is going to start declining in having a negative growth rate in 26 over 25, that it's all over this year. I mean, I think that is as likely as you and me go into space, Paul, frankly. So we think that there's going to be lots of upgrades because of the nature of their high gross margins, and it's a manufacturing type business. You get high drop through to the EBITDA, so the profits will come through. I think we're looking for 14 million of EBITDA. So it's 10% of Rockwood now. We're running our winners. Very important to run winners. So no reasons they're doing their. Yeah, I'll keep it brief.
Yeah, okay. So, well, a quick follow-up question on from Richard P. Just on that. How do you value it? Because I think he's in it as well, and he's struggling with the sort of, like you just say, they got about 50 million of sales. Market cap is roughly just over 200 mil, so about just over 4 times sales. How do you value it, Richard?
It is more difficult now with exactly where they are, because they haven't released the contracts, to be as confident about the valuation case than we were earlier. I'm not trying to dodge the subject, but we're thinking about multiples of sales and the drop through to EBITDA. So if they could do within the next couple of years 25 million of EBITDA, you'd put a high multiple on that because of the growth. And the current 200 million pound market cap could look very silly. If just to put the contracts they might win, they've said they've left a sort of trail of breadcrumbs that they're trying to win other wavelength bands to go into the ground stations with for Starlink. They're saying that the other wavelength bands, the amount of sales they could get from them are sort of the same as what they get from the band that they're in at the moment, which means that sales could be going like doubling. So we need them to win. We need them to win the contracts. I think, as I say, running winners, you give them the benefit of the doubt that they're going to announce contracts which will justify a higher valuation and a lot more sales during 2024, during 2025. At the moment, based on all we know, it looks relatively fully valued. But I expect good news to change that place.
Good. Well, really well done on that one. Another one you've done really well. We've got his funding circle. We've got a question from Les, who's also a Rockwood shareholder. He's asking what your latest thoughts are on this one. This is a P2P lender in the UK, sold off its US business, and now is really sort of like hitting its strides in the UK. How do you see this one going forward?
Yeah, so it's been a huge transformation in 2024 for the business. We were involved with helping to catalyse that through engaging with the board, the management, and other shareholders earlier in the year, because they'd been sitting on a huge amount of cash that they didn't really need, and they've now entered into buybacks. So they've announced 50 million of buybacks so far, two stages. They're still in the second one. We expect them to continue to announce more buybacks. They've definitely still got excess capital, and they've got about 160 million at least of unrestricted cash on the balance sheet still. The second thing we asked them to do was to accelerate the move to profitability, take some costs out of the business, which they've done. It looks effectively. So they went into profits for the very first time in the second half of last year. It was a £15 million cost-cutting program. So what you've got is a business for the very first time coming into profitability. Now, they've got some pretty exciting targets, which they've reiterated repeatedly in every, for the last couple of years, that they think that they should be doing 15% profit margins and growing the top line by 15 to 20%. The year on year in H1, we haven't had H2 yet, although they've said they're in line, was 60% year on year. And why are they growing like that? Well, I think it is actually because lots of normal businesses, which is who need to borrow money, are really struggling with our modern bank system. And I know this just from lots of conversations I've had with not only through work, but through friends who have small businesses. The banking system just isn't what it used to be. I have referred to this before, but like Captain Mannering from Dad's Army was the local bank manager and ended up in charge, and everyone he trusted, everyone knew him. And you could go to Captain Mannering as Mrs. Miggins' pie shop or Rosie's flower shop and say, we need 50 grand, we need 25 grand, and that's how it worked. Well, those branches just don't exist on the high street anymore. And Rosie has to ring in to the mainstream bank, and she's still on the bloody menu for to get through to speak to someone after 20 minutes. I put that into context. The average application for a funding circle loan is 6 minutes, and 76% of people get an instant response. Yeah. They've now lent to over 100,000 businesses, 13 billion quid. They've been doing it for 14 years, and they've invested 100 million at least into the platform. And it's very unlike sort of technology-driven platform companies like that. They've been really quiet about the level of sort of machine learning and AI that they use in this amazing database that they have. I'm encouraging them to explain to people that what their secret sauce is. But that business now is on just under 7 times EV/EBITDA to 2025, which is their first year of profitability. It's a platform business. This is what's exciting. So, further growth, now they're in profit, drops through to the bottom line. In many ways, I know the stock I'm about to mention has fallen from grace a bit, but it reminds me a lot of Hargreaves Lansdown as a sort of where they were early, well invested, did a very good service. As a result, won a lot of customers and became very profitable, and the stock market loved it and put it on a very high rating. We're just moving into that now. Now, it's fair to say we did start buying at 31.5p, and so we've sort of done a 3-bagger so far. But we think it's they've got lots of scope for further outperformance and growth, because they're still not lending huge amounts in the grand scheme of things.
Yeah, we haven't got to apologise for your great returns there, Richard. And indeed, as I'm sort of like a more private pike kind of character, and I could see this one being taken out by somebody like Revolut or Monza or Wise, because platform business, and they add on all that lending, so it makes a lot of sense. But yeah, really well done.
Well, you're right in as much as it's definitely a lot cleaner purchase now, because before they had these heavily loss-making US, now it's just straight UK. If someone does want to own it, they probably want to crack on, I would have thought, because it's going to get more expensive, I would think.
Yeah, well, they're all those ones I talked about are moving to super app type propositions across all financials. Anyway, let's move to another one in the financial sector, servicing the sort of like not so much the subprime, but certainly the more financially challenged sectors. They do credit cards, the Vanquis Banking. It got sort of like wrongly caught up with that car finance stuff, which was for the FCA having a look at, but I don't think they do much of it. Anyway, when did you get involved, and what's sort of the investment thesis here in Vanquis Banking?
So this is, I'm hoping, so sort of thing, obviously hoping, but we've done a lot of work. So hoping this is sort of when we did talk about Filtronic and Funding Circle at a much lower share price, and then we sort of moved on, and then now I can sort of be sort of unacceptably kind of happy about the fact we've made lots of money. Vanquis is at the start of the journey, so this will be the one we hopefully we'll talk about, because genuinely our investment thesis, I know we target minimum of 100. We think this is a 4 to 5 bagger if it works. So it has 2 parts, as you say. It's the old Provident Financial, which also went wrong and was, I think, in the near the FTSE 100 at one point, doing doorstep lending. But their activities now are just Vanquis credit card, below prime. I don't really like the phrase subprime, to be honest, but below prime. They obviously charge more for that, but they're not Wonga and that sort of rates.
Yeah.
And what's interesting is those things have all been regulated out. So that's, again, there was all these people offering kind of very short-term credit for people that were really in need. That's been regulated away. The mainstream banks don't sort of like this sort of, they just tend to stick to their kind of prime type lending models because of their histories and all the rest of it. So there is a kind of need. Now, the Vanquis reckon there are 20 million people that are financially stretched in the UK. They are the market leaders. So they've got over 1.5 million customers now. And these are people that, it's sometimes, when you just get the occasional problem, you need some extra money, and you've probably got a low credit rating. They do tend to generate very good returns because of the risks that they take. So the net interest margin at Vanquis is just over 18%, which is really quite good. You all know mainstream banks are sort of 2.5 or something like that. That's pretty cool. They happen to be very well capitalized. So they've got a tier 1 ratio of 19.8%. Yeah, but their regulatory requirement is only 13.5. So they've actually got excess capital currently, which is helpful because we'll come on to the motor finance thing in a moment. What's exciting us about it is there's a brand new team and they're really high quality. So the former head of Bank of Ireland is the new CEO, Dave McLaughlin. Probably pronounced that right. Sorry, Dave, but it's Ian. Sorry. And Dave is the CFO. Apologies, Dave Watts. He was HSBC UK CFO, very highly experienced banker. And the chairman, Sir Peter Estlin, is also as head of financial services at PwC. And they collectively come in to sort this business out, which had a huge lack of investment in its systems. So they're rolling out a new IT system, which won't fully land until Q1 2026. Again, patience. They're not doing a bespoke one, Paul. You'll be already alarms flashing. Off the shelf, nice and low risk, but that's being rolled out. That's allowing them to take out loads of costs, lots of manual processes. So they're doing a 75 million to 100 million pound cost-cutting program currently that's in process across the business. And they think the business, given those net interest margins, what they're about to say sounds absolutely reasonable. They should generate a kind of mid-teens return on tangible equity, which, if the stock market behaves like it has done for the last 100 years, would justify a decent premium to book value for the shares.
Yeah.
The shares are currently trading on 0.2 of book value.
Yeah, I got the net tangible book at 144p with the shares at about 50p.
Exactly. Now we think they can, just to be clear, if it all goes right, this business will doing at least run rate profitabilities of 100 million PBT a year. The market cap is 125. Now let's get on to the risks here. It's a bank, so it's leverage. They have deposits, so it's really regulated. So for anyone thinking, are they a bit dodgy or anything like that? FCA regulated, PRA regulated. I mean, arguably, it's sort of, there's too much regulation of these guys, and they should just be well run by honest people for the benefits of their customers. But so they have deposits. You can get a very good deposit rate at Vanquis, say over 2 billion. Most of the money is the people putting FCSS 85 granders into, so it's that kind of money. I lose my train of thought, but
was there any exposure to that car finance?
Yeah, that's it. Okay. So they bought this thing called Money Barn, which was a car finance piece a number of years ago. I think they actually paid sort of 100 million for it. That's now a third of the business, and it's doubled in size since they bought it. But now obviously it's worth nothing and all the rest of it. There's two pieces with the motor finance. We due diligence the first risk, which was that the first problem came out because the regulator was upset about people using third-party brokers. Beautiful for Vanquis. Their systems were so bad they couldn't even use third-party systems, couldn't use third-party brokers. So the guys could just say, we've got no exposure. We couldn't do it. We couldn't do it even if we wanted to do third-party brokers. So they've definitely got no exposure to that. However, the second thing, which was the court cases, basically opened up this sort of Pandora's box that all car loans they've ever had done might require some redress because there've been commissions paid when you took out a car loan. The Court of Appeals case is now going to the Supreme Court. We've had meetings with Oxford University law professors who are experts in this area that think the appeals court was literally, completely wrong with their judgment. So we think there's a high chance there is a turnover. In a worst case scenario, it may be that there is some sort of redress that Money Barn just have to do for certain types of customers or certain whatever. But we've actually had lots of conversations where we say we don't want to release any numbers that we're not comfortable releasing into the public domain. But the reality is we know how many lends Money Barn has done overall. We know what the commissions were paid. And as I mentioned earlier, we know they've got excess capital of over 100 million. And we also know that if the recovery comes through and these regulatory things, PPI took years and years and years. And obviously the market's immediately gone, it's PPI again. But it doesn't feel like that, to be honest. If they're making 100 million of profit a year, they will be able to cope with some level of redress in a worst case scenario. We probably won't make 4 to 5 times our money if that scenario comes out. But I think even if that scenario comes out, I think we could still make a strong return from the recovery of this business.
Yeah, well, I hope there's sense in that whole industry, and I think even Rachel Reeves has tapped some of the that superior court, those court guys on the shoulder to try and not influence them, but just point them in the right direction. But anyway,
some of the DD we've done that's kind of relevant. You kind of sort of, if you actually look at the actual writing for the Vanquis, the main Money Barn loans and stuff, it says next to where you sign this agreement that you're borrowing money to buy a car, that it says next to it there is a commission payment for, you're agreeing that there is a commission payment for this to satisfy this. That's a bit different from the BMW one, which is 16 pages long, and it references it in page 7.
Yeah.
I don't know how well you read your 15-page finance agreements, Paul, but there might be some levels of some, But we think they're in pretty. We think it's over. We definitely think it's overblown. And surprisingly, you will have noted that Secure Trust Bank and Close Brothers, 2 other companies exposed to this thing, have motored so far in 2025 off the back of the Rachel Reeves thinking she might have to intervene. But Vanquis, it went up a little bit, but not much more. And I would put that down to classic Rockwood stuff. No one's looking at this stock, Paul. No one looks at it. No one's interested. It's 100 million. It's in financials. It's just people aren't looking at it.
Okay. Here's another one which in the financials, which hasn't been looked at for at least 12 months, is Argentex, which is a sort of like a silver service type foreign exchange outsourcing offering for corporates, for SMEs and for fund managers and stuff. And it went through some trials and tribulations about 12, 18 months ago, had a management change. And the big sort of like turnaround is to bring in this alternative banking solution to add it onto their sort of like white glove service. What's your latest on this one? Because when we last spoke, we were both skeptical of the actual chance of putting in an alternative banking solution on top of all their existing services, but they do seem to be tentatively proving us both wrong here, Richard.
Yeah. I'm pleased I've been not emotional about this one, because it's kind of as the share price shows you, there's a good reason to be emotional in this stock. As we discussed before, for Rockwood, because we realize, because the management team that were meant to turn it around have had to change, happened relatively early in our holding period, we were able to support what I call a reboot. So, but it does mean the new guys only have got 3 years rather than 5, which is because it took 2 years to realise things had to change. Our average price, sadly, Paul, is 59p for this. So we are on a loss. Now, I think the most recent update was obviously a beat. So they announced a beat for numbers about a couple of weeks ago and said they're going to be doing about 50 million of turnover. Now, Jim Ormond, who's gone in, is extremely well respected. Nigel Railton, the chairman, who's very actively involved in this business and was formerly from National Lottery Camelot and very experienced in it, he literally will go down with Jim if Jim doesn't do this right. He is literally, Jim is our man. He is the man to do this. He knows what he's doing. He's going to sort it all out. There's no doubt that the business did need to a certain extent, more professionalization, definitely more, and some costs. And the product strategy needed to be evolved with this alternative banking system. But also they are quietly expanding into Australia, Europe, Dubai next, we expect. All these because it's a very profitable activity, high margin activity with limited capital costs. They all should be making a contribution relatively quickly to group profits. Why that's relevant is, as you know full well, I'm sure, is that the expectations are not very big for this company now. In fact, the estimates are for zero growth in 2025 and less than 2 million of EBITDA. And for those that don't know the company, just right, it used to do 12 million plus of EBITDA a few years ago. So the potential to generate significantly more profit once they've got a stable cost base and grow it should be material. I think we've been I'm not going to let the cat out of the bag, but we've been engaged with as have all the other larger shareholders with the company about an incentive scheme for Jim and his team. So got a new CFO as well, Guy Rudolph, who's excellent. So they need incentivizing. Without saying that you would expect from Rockwood us to want a scheme which is very much focused on the share price. And we have high expectations for how much, what deserves to be people being paid significant amounts of money. And that would require Jim and Guy and Nigel to get the share price up very significantly from here. So you should see that soon. That should focus them on doing the right thing. I say that in the context of, I know that you're an equal shareholder, and it is a space where there continues to be a lot of corporate activity in M&A, and there must be people who will be looking at Argentex. Except I'm with the Beckwiths who are behind Pacific at 29.9, to a certain extent us, and I suspect Gresham House as well. We're not going to let it go on the cheap. The guys have got an opportunity now to kind of demonstrate the value to anyone else that they pay up properly.
Yeah, well, I'm a shareholder also of Argentex. We've got a couple of follow-up questions on Argentex for you, Richard. Everestingly and in Ignatius Pinto. He's basically, what's your level of confidence now in this turnaround, given that both of us actually were pretty, we were sort of reluctantly skeptical sort of like 12 months ago. What's your sort of level of confidence now, given that they effectively did 26 million of turnover just over in the second half?
Yeah, truthfully, it hasn't changed much. Yeah. So I think they're doing what they said they're going to do so far. We haven't really seen the financial performance to support saying it's on track yet. So for me, I'm still at kind of 50, 60, probably 60% confident, right? This time next year, we should be in a position to be at 80, 90, and then it's a decision they're either going to do it or not, because they should be well on their way by this time next year, and the shares will be a lot higher, and they'll have delivered better profitability than expected and stuff like that, or not. But it's still a little bit, that beat in January is good, but they really did create to the numbers. It wasn't going to be too difficult to beat that. So what we need to see is the profits starting to lift, and then you get confidence that the turnaround will happen.
Okay, good. We've got a question from Simon Monk asking about another one of your successful turnarounds, RM, which is the EdTech business that you pointed out about 12 months ago, provides services into sort of lots of education bodies in the UK and abroad. How do you see this one going forward?
Well, it's 14% of my portfolio.
Okay, this is the biggest position, is it?
It's my biggest position, and we've bought 15% of the company. My conservative target is 170 million of some of the parts value, and we've obviously made a decent return. That's partly the reason why the position is high, but also we bought more during the way as well. So I think we started buying at 26p, and they're at 110, but as I just explained, still loads and loads of upside. They've taken their time, and it's fair to say, if you ask the management, they'd say Richard does keep pestering us about this. But the view that I've requested repeatedly for the last 18 months that they dispose of at least one of the divisions. Firstly, to pay off the debt, and secondly, just to start realizing value for shareholders. They have yet to do that. They've been helped by the fact that the banks understand the value in their business. So the banks have been very supportive with quite a big debt load. Now, they've also had an update before Christmas saying that debt's going to be better than expected, that the turnaround of profitability was on track. We haven't had the results. We're in quite a quiet zone. Hardly anyone covers this stock. So the results coming up are going to be very important. They've changed broker at the back end of last year, which usually is quite an interesting sign that changes afoot at the company. They pointed to Singer Capital Markets. So I expect, and I'm going to get literally very, very upset if we don't see the first disposal like super soon. I mean, they've had time to sort it on the rest of it. So we'd expect them to announce the first disposal. I don't know which division that will be. We could speculate between the two of us, but one of the divisions is an absolute cracker, which is the one that is called assessment, which marks exams. During last year, won an unbelievable contract with the International Baccalaureate. They actually won over 100 million of contracts last year in assessment. And I think that positions them as global leader in the digitalization of marking exams globally. That's really important for them. That division we think is worth at least 100 million quid, possibly more. It's growing at double-digit rate. It has 20% plus margins. Unlikely they sell that first because that's just rocking and rolling. The technology division has about 55-60 million of sales, something like that, and makes a sort of single-digit margin. That would make quite a lot of sense to sell. And we've got it in our sum of the parts. We've said that's worth sort of potentially up to 50 million. The debt last stated at RM was 52 million, but we know it'll be slightly less than that by now. So the tech division could quite nicely just kind of wipe out the debt in RM, leaving them with the two remaining divisions, the Butte. And then the other one is TTS, which is the one that both develops its own, but also buys in curriculum aids, teaching aids, and other supplies into schools. So for your listener that asked in, I would say we've got a really big catalyst coming up. The team have all changed: new CEO, new CFO, new heads of divisions, new head of people, new head of digital. I mean, it's just, and they're all now in place. So we should really start seeing delivery at RM in 2025.
Yeah, well, big thanks from my dad as well, because he took your idea about, I don't know, 9-12 months ago. So he's over 50% increase in that. So he sends his thanks there, Richard. So brilliant. Okay, right. Let's move to another one, which is going through an early stage of a turnaround in UK specialist piling business, Van Elle Holdings. John Dunn is asking about them. They seem to be doing pretty well abroad in Canada, pretty well in sort of electric transmission and generation, but rail, the CP7, does seem to be struggling a bit. But in the round, then, how do you see this one progressing going forward?
I suspect other people are quite frustrated about Van Elle. Why? If you look, you've got the 5 year. I mean, do
you want the 5 year?
Yeah. The share price of Van Elle has basically done nothing for 5 years.
Yeah.
The CEO, Mark Cutler, who's a very high quality operator, has during that period materially professionalized the business, improved its capital disciplines, its processes, focused it up. But he's been there 5 years, and we shareholders really haven't made any money. What's interesting is this, during the last few years, like sales have almost doubled. So sales are now 150 million. That's what we would expect in 2025. But profitability, PBT, hasn't really changed that much. They have had some external issues. So 40% of what they do goes into the house building market, which you'll be aware has been pretty soggy for some time. But it's been, and I think management would say the same thing. They've been a bit frustrated. They have won rail work, but they haven't really done, and they haven't made a fortune out of HS2, which seems to me a missed opportunity given how much it seems to have cost. That's got to go somewhere. So I don't quite understand why. And Van Elle has a very, very strong position in rail. But it has been positioning further into water and other infrastructure. They have quite an interesting contract just recently, which will be to do with the grid investments going on that will go on in Scotland, and there could be quite a lot more contracts from that. So they do have good exposures. And house building, let's face it, there's quite a lot of reasons why you could argue house building is about to start to recover. So all of those things are quite positive, but in 24, they made 3.9% operating margin, and they've been targeting 6 to 7% operating margin for the last 5 years. So we are nowhere near what we've said we were going to do. They've said the target ROCE was 15%, and we're still at like 10. The balance sheet is not very. Everyone has different views on this sort of thing, but they've basically got cash on the balance sheet, so it's not optimally structured from a balance sheet perspective. And you wouldn't want huge amounts of debt, but let's face it, they've got 130 rigs, so you could have their asset backed, so you could have some debt, which could be maybe thought about. Now, I think what I'd leave you with this is that if you look at the shareholder register, it's very concentrated. So Otis, which has a history of active engagement with companies, has got a big stake. Ruffer has got a large stake. We've bought just over 9% of the company, including adding to our holding recently. And Peter Gillihammer, which is the first time we've done that for a long time. And Peter Gillihammer, I don't know if you're aware of.
Yeah, no, big private investor.
Big private investor. He's just gone notifiable in Vanel. It's bloody. Sorry, excuse me. It's very cheap. I mean, it's on a 3.5 times EV/EBITDA. It's on less than 0.8 of book value. That's real book value. It's not goodwill. That's rigs. It's on a PE of 10, making a margin that really should be higher. Competitors make higher margins. It should be higher, with end markets that are either in structural growth or have decent recovery opportunity. So I think something needs to happen here soon for shareholders.
Yeah. Well, there you go. In terms of, if there's a lot of active investors on board, then it should be at least moving in the right direction. Okay, let's move to another one in the similar vein. We've got a question from Innes Gray asking about Flowtech Fluidpower, which is, I guess you're probably going to use the same word, frustrating, over the last 5 years for this one. It basically does all things sort of, well, it says it fluid power, so pneumatics and what's the other one? I can't. Yeah, basically hydraulics. That's it. Yeah, parts and stuff and services associated with it. How do you see this one?
Yeah. So again, pretty frustrated from a kind of how long it's taken to get to this point. But genuinely, we are at the point now. So for those that were clever enough not to be involved early enough or whatever, this really is a very good time to be looking at Flowtech Fluidpower. Why? Because Mike England, who's the new CEO who went in, has done a root and branch transformation behind the scenes on this business. And you can't really see it very, very clearly, the impact of that yet in the business, because end markets have been very tricky. And I'm afraid this really is one where, if you're a macro investor, you might want to just avoid it anyway, because they are exposed to manufacturing mainly, almost entirely in the UK, and the industry association for fluid power essentially had it down -10 last year. Yeah. So they didn't do as badly as -10, but it's very difficult to see the benefits of turning around a business when you've got those kind of headwinds. So if those don't go away, it's going to remain pretty tricky for them. But there's certain signs that should gradually abate. So they've done a lot. He's done all the hard work. Now, if you look carefully into the accounts and stuff like that, you can already see the benefits. So their gross margin's starting to tick up because they've got a load of initiatives there about sourcing, product suite. There's so much sort of good business things that they've been doing. He's changed 60% of the senior leadership team. And I think the really interesting sign is the acquisition they did at the back end of last year, which I think it will be an indication of what's going to come with these guys. So they bought, despite all the difficulties and stuff like that, everyone else in this industry is also in a lot of problem, but they're typically not as big as Flowtech, who has a decent level of sales, pretty 120 million of sales this year. So they bought a company called Thorite out of administration for nothing, basically, which 2 years ago was doing 20 million of sales. and they've already got their money back. And now they've integrated it in, and they've just done a recent trading update saying that it's fully integrated, done better than expectations. That would have created a lot of value for shareholders. And I think we'll see the Thorite driving some real improvement to returns during 2025. They also kind of flag, and the broker notes are sort of flagging this. There's clearly more things like Thorite out there that Flowtech could be looking at, buying basically out of distress, adding it into their now good platform to accelerate sales. Because part of this thesis is like with Rockwood normally, is improving margins. Last year they made £1 million PBT. Mike believes the business can do mid-teens margins, which competitors do, and there's a lot of with due diligence that's reasonable. If they do, and they continue to, and they start growing the top line, we actually think my EBITDA target for this on a 5-year view is 20 million of EBITDA. The current market cap's 43.
Okay.
Harwood have bought 29% of the company, and Harwood Associates. Jamie Brooke, who's on the Rockwood Advisory Group, is on the board. And Roger McDowell, who you'll remember from Augean days, another massive Harwood success and a Rockwood success as well, is also on the board. So we've got excellent board, outstanding CEO, a lot of stuff they've had to get done with a difficult end market, but a huge recovery here. So I think it's really very interesting stock.
Yeah, no, I'll have a good look. I'll have a good look at that one. Thanks very much. Okay, let's move to another one, which is gone through a transformation. Pressure Technologies. It sold off its oil and gas business, and now is just solely into sort of large scale, high performance cylinders. And I think he just won a contract with the Royal Canadian Navy to in there for their submarine fleet to put high pressure tanks in there. How do you see this one going forward? Again, it seems as though it's on an upturn, but early days, I guess.
This is one I'm afraid we're going to have to move on.
Oh, okay, that's no problem. Yeah, because you're on the board, aren't you?
I'll tell you what, I'm on the board. There are no guidance in the market, and we've got results coming up in the next couple of weeks. Yeah. So I think it is inappropriate to talk about it. I'd love to talk about it after the results have come out.
Yeah, no problem. Okay, we've got a question in from Innes Gray asking about James Fisher, which is similar in oil and gas. And I think it does all things sort of like subsea sort of stuff, maybe a bit of decommissioning as well, going through a turnaround. I think you remember last time we had a really good CEO as well who's been put in. How do you see this one?
That's right. Yeah, he's called Jean Vernet. He's a very commercial Frenchman with a fantastic CV, very experienced executive. And he ran the John Crane business at Smiths, which is a bit in the news at the moment because Smiths is sort of looking at breaking itself up. And he also worked at places like Schlumberger, which is relevant because, as you said, James Fisher is exposed to marine, energy, and shipping markets. He's again classic Rockwood. He's looking to turn the business round. In 2024 they made margins of 5.6%. His stated target is 10% margins, so literally a doubling of the level of profitability on roughly the same level of sales. There'll be growth coming through. How he does that, again, he's been in there 2 and a bit years, so he's under, he knows this is the year to deliver for Jean. If he doesn't start delivering proper profit recovery this year, then there's something awry. I think he will. In fact, I think there's going to be a good upgrade story at James Fisher during 2025. The key piece within the various moving parts to delivering that recovery is the defence division, which was loss-making and then now slightly break even. And one of the main reasons for that was just a lack of business going through the division. They've been talking consistently about a build-up and a big pipeline of contracts. That's quite lumpy, being defence. But they have developed this absolutely super cool, it's called a SEAL carrier, which is this really cool kind of submarine. Well, it's basically a speedboat for special forces that's about 12 meters long. And you can drop out of helicopters, and then it can go 30 knots on water, but it can also go semi-submerged and fully submerged. And it's proper James Bond. Yeah. And those they're actually expensive pieces of kit. Now, the reason I mention it is because in America there is a urgent operational requirement. That's the thing for this sort of thing for the SEALs, there of which there are 50 teams in the US. It's as a product, there's no other products, so they've had to develop this thing for the usage. It's been doing cold water trials in Scandinavia and warm water trials in Miami, and there are a range of obviously nations that would be interested in it, or those with coastlines and all the rest of it. They announced on their website a win with the Indian Navy recently, which looked like they didn't want to make too much of a fuss about it, but we suspect they're starting to win some orders. This will be high margin, and that's all they really need. And then the defence margins will start to turn around, supporting the rest of the business, some of which are already producing in excess of 10% margins. The other thing John has been doing has been a bit hamstrung. He needed to get the debt down, so he did do that, and it's had a couple of disposals last year. So the debt, James Fisher's down to 68 million. It was an over leverage, which should have focused. James Fisher, by the way, was one of those sort of everyone loves James Fisher stocks a few years ago, where all the mainstream small cap managers all loved it. Oh, James Fisher's such a brilliant business. It used to be on like 11 times EBITDA, year in, year out, and everyone was like, oh, it's so fantastic. So you can now buy it on 4.3 times EV/EBITDA. You could buy James Fisher on 4.3 times EV/EBITDA, when we know that the margins should double. So the EBITDA number that you're backing your 4.3 times is going to be much higher. This could be a multi-bagger if Sean starts to deliver during 25, 6, 7. So very excited. Harwood and Harwood affiliates were up to 10%, just over 10% of the company. We really believe in this one.
Brilliant. Okay, well, we're running short of time. We've just got to mop up 3 companies that we've got questions from your Rockwood shareholders. We've got to start with STV Group, a Scottish TV linear programming broadcasting, got a studios business and a digital arm as well. How do you see this one, just quickly?
Very quickly, super cheap, 4 times EV/EBITDA, I think. Dividend yields over 6%. Oh my God. PE is like private, PE is 5 times. Some debt, but not a huge amount of debt. It's like 1 times net debt EBITDA. Problematic pension fund, big, 300 million of assets, I think, and liabilities, and a 50 million deficit. Real problem for them. They've got this. So the deal with it is they have to pay in 10 million quid a year out of free cash flow into this blooming pension fund until 2030. Now, at the start of this call, we talked about patience, right? So for the most patient of you afterwards, this is what's exciting. STV's market cap is 93 million. And having paid 10 million quid into the pension fund in the last 12 months, it still produces 10 million quid of free cash flow.
Wow.
So basically, this is on an in excess of 10% free cash flow yield after paying 10 million into the pension. So for those that can wait to 2030, this will have 20 million of free cash flow if nothing else changes, because that's the last time they have to pay the 10 million in. By the way, they're probably working quite hard to do anything they can to sort of accelerate that process, or not wait till 2030, maybe look at buyout options or take out risk and stuff like that. Whilst they're doing that, the 2 things that's going on is, what is STV? Well, some people kind of yawn and go, isn't it kind of the next newspaper because it's broadcast TV? And then forget that 2/3 of all TV watched in this country is still the broadcast, the terrestrial broadcasters. It's the number 1 peak time. If you want to hit the Scottish nation, they own the peak time viewing in Scotland. Interestingly, their player, which lots of people use, the digital player, that's like, I also thought about, I know there was this thing that someone, it's this really old concept that people haven't heard of for a long time called IPO. They used to do them back in the 1980s and stuff like this. So STV has a business, the STV player business has 20 million of sales and makes 10 million of profit. And it's been growing every year for the last few years. If that IPO'd, I'd be interested what a stockbroker would come up with, what that business alone would be worth. But with the digital, they know specifically that it's Paul, and Paul likes watching Mortimer and Whitehouse, which I'll come on in a moment. So because he knows that they can direct an advert to you if you're watching through the player, and then the advertisers will pay a lot more for that advert than they would for just a blanket in the middle of the news, not knowing who's watching. That's the last piece. So the Mortimer Whitehouse piece. So, but they would accept that broadcast TV is not a massive growth industry. So they've been looking to, how do you pivot? And the pivot's been into production and studios. Now, hot off the wires this morning, you may have seen, there's been rumours that Redbird IMI are looking to maybe do a deal with ITV on their studios business.
Oh, wow.
Yeah. You'll also be aware that ITV separately had some sort of, there's been bid rumours about ITV.
Yes.
And you'll also be aware that the production industry in the UK is a growth industry for many reasons. So they've been going up. They're targeting over 140 million of sales now for the studios business at STV, and they used to just do literally Taggart. I'm not going to do this being a murder in Scottish accent for all those people listening in Scotland, but they used to do Taggart and they own Catchphrase, believe it or not. But more recently, they've been winning commissions from Netflix, from Apple, of course from ITV, but also the Beeb. They do Blue Lights. Bridge of Lies is one of theirs. They own the Mortimer and Whitehouse thing. They bought that business, combination of organic and acquisition, and that's pivoting it away from just being a traditional broadcaster. So we think it's a strategic asset. You can't get the number 3 slot on the EPG without owning ITV or STV. Lots of people might want to own the 3rd slot on that. And it's been currently valued at £93 million.
Brilliant. Okay, good. Let's move to another one. We've got Adam, who's wants to know about Kooth, which is the digital mental health telemedicine business that is the UK's #1 by a mile. In fact, probably the only one for under 18s, digital mental health. Went out and won some contracts in the States. I think it won the California one, the Pennsylvania one, and just recently won a pilot, I think, with New Jersey. How do you see this one?
Yeah, it's a new holding, so we're early in. We haven't made any money on it yet. We're in at about 160, 165 is what we've been paying for the stock. We've bought at least 4% of the company to date. You're right, it is the market leader. It's been around for quite a while. So people sort of think it might be a kind of a young button, hadn't really proven itself, but it's been serving the NHS for over a decade. They have over 100 NHS trusts that use the Kooth service, which is essentially a digital front end sort of hybrid service, so that you can anonymously, young people can get advice and chat and learn about them things that they're worried about from a mental health perspective, and then you can move to having a kind of a counselling or a session with a real person, and then you can move from there to then actually accessing full treatment and multiple sessions if needed. And the idea is to sort of get things early. You know, it sort of leans into where the NHS needs to go with a lot of its services. So from that kind of proven out service in the UK, they did win this California contract. And then they had some real bad luck in the summer, in the run up to the budget, when no one was buying AIM stocks under any circumstances, and obviously Kooth is an AIM stock. And the 3 things happened. They did a placing of the PE private equity house that sort of got it going and still has a big stake. And that was oversubscribed, but not long after the placing, they got notified that one of the contracts in America, that I think Pennsylvania, was being cancelled. I mean, even, you don't have to be interested in politics to know that Pennsylvania was one of the key swing states in the election and became highly political. And that's actually what happened in the backdrop around that contract going from a pilot to a full-time. And it's a Republican state now. So they lost that contract. So everyone was a bit miffed that had taken it in the placing, probably more than miffed, probably quite upset. Secondly, what happened was there were 4, apparently, no, I don't want to exaggerate. It's either 200 or 400 people applied for the California contract that they won. So I think we can assume that within that mix of people, have been a few people a bit upset that they didn't get it. So, and it took them less than a year for a big hit piece to come out on how badly Kooth are doing, and that they might have the contract taken away from them, and all this sort of stuff, and throwing out some other sort of slurs that have been unsubstantiated about their business activities. And that sort of like, everyone sort of got a bit nervous about that, and took another hit. So more recently, as you said, they just won another US contract, which showing that they are winning it, and they are winning pilots in the States. There's at least 11 blue on blue states where there's no Republican. I don't think sees this as only being a blue product, because Republican states are interested in it for different reasons, but I think the easiest ones are probably blue on blue states. So they would continue to win. The growth could be huge if they continue to win in the States. I understand there's also been an RFP, which is public information, that Australia wants to do a mental health nationwide system, which Kooth would definitely have a chance of at least throwing their hat in the ring to help with that. It's got about 60 million of turnover now, and market cap's about the same. It's got loads of net cash, and and it's run by some very sensible people. They've just announced a new CEO. I'm pretty sure I'm the only fund manager. Well, that might have changed in the last 5 days, but I'm definitely probably the only fund manager that's actually met the person that's becoming the CEO. Because as part of our due diligence, I asked to meet levels down and met Kate, who's a very, very capable individual, and I think she's going to make a fantastic CEO of the business.
Brilliant. Well, let's all hope they win some more contracts, particularly out in the States and out in Australia. They have got a brilliant reputation in the UK education sector as well as the NHS, because my wife used to work in the school and they were using it and said it was fab. Okay,
oh, really?
Yeah.
Well, Paul, I know I'm not meant to, but just if you try to, again, Rockwood, we're always trying to do asymmetric stuff. Asymmetric meaning, how do we limit our downside, but definitely at least make 100%. Obviously, Kooth works. It could be again a multi-bag, but we can see a path through to at least 100%. If you take just the UK business, we've tried to split it out as part of our work. We think the UK business has got about 18 million of sales and it's probably making 6 or 7 million of profit. If you just sold the UK business to someone that wants to run the UK, you'd get a decent amount of money. Then you add the cash, they've got about 14 cash. That gets you to the kind of current market cap, meaning whatever happens in America is kind of in for free. Seems pretty onerous.
Yeah. Okay, final question, just from Ben Sharman. A couple of words on Pennant International, which is a training business largely for defence. I think it does a lot of sort of like software and simulation for things like fighter pilots and people who need, sort of like to be able to do extreme things. So how do you see this one?
Yeah, it's a small position. It's less than 2% of NAV. It's very early stage. It's something that I'm not getting emotional about it, but it's becoming a bit of a project for us, because we think it could be a platform to become a very significant UK defence business over the next decade. That'd be the kind of vision. And it's been around for over 100 years. What they do they were slightly off on what they do. What they really do is, if you think, what's the right way to think Apache helicopter, which is one of their contracts. So we order a few Apache helicopters from Boeing for the UK. Everyone immediately thinks of Apache helicopter gun shipping people and flying about and all exciting. But obviously most of the time it's just sitting in a hangar needing to be kind of tuned up and fixed and all the rest of it. What they produce is the now digital, but it used to be paper, documents of all the stuff. So what are all the parts? Where do you get them from? How they all kind of, so it's a kind of, and obviously, Captain, not Mannering, because it's I can't keep talking about him, but if you take, the guy who's like there, he might leave the RAF, and then you need the next person to be able to sort of sort it all out. There's a whole sort of sector in doing that, very repeatable revenues, and their customers are very sticky, and they do that for platforms, everything from the Challenger tank to the Apache helicopters to a range of other stuff. And they do it and interestingly, for such a small business, they do it for, Australia, Canada, obviously UK, US. It's a very interesting little business. The problem's been is that we think very talented CEO Phil Walker, frankly, just hasn't had enough support running that business. So we've been in 2024 laboriously trying to help actually basically change the whole board and get the thing into a place to support Phil for this business to become what it could be. And in short, so we've got a new chair, Ian Digate, who's city facing and has a city background, understands shareholders and what shareholders want to see, very commercial like that. We've got a new audit chair who's come in, who's a finance guy that I was on a board with before, who's very strong. Klaus has come on, who is the CEO of Interseed, a very successful software site. I don't know if you've come across it.
Yeah, I do. Yeah.
They're pivoting to software from being more the business, so they need some software expertise. A guy called Rakesh Patel, who used to be the CEO of Ultra Electronics and did all their M&A for many years, which became a £2 billion UK defence company. He is a board observer. We've changed the CFO, so the CFO is ex-Melrose, ex-Megit. We're nearly there. It's not quite there. And then they've been having to do some restructuring. They've got some buildings that hopefully they'll finish selling shortly, and that will put the balance sheet straight. And then what the plan is here is we want Pennant to become a buy and build strategy, a bit like Marlowe was for many years. I mean, Marlowe got over carried away later on, but essentially we think we could use the platform to buy a range of private, smaller defence businesses and create a group of scale of value on the London stock market, and prove that's why it's slightly emotional. Show what the point of how the stock market can work for everybody, both investors, shareholders, businesses. We need some examples, and I'd like Pennant to be one of those, basically.
That's a fantastic vision, that is, Richard. I don't think many fund managers come out with sort of like those type of strategies for businesses that they invest in. That's absolutely terrific. Okay, I've got one final question, just for in terms of the rest of the year and beyond. What's your sort of like the stock that sort of like really gets the Staveley pulse racing, given that you've obviously delivered fabulous returns anyway over the last 5 years?
I'm going to upset you, Paul.
Okay, you're gonna shirk it, are you?
I'm telling you. You once asked me in a conference what's my hit rate is. Yeah, yes. I can tell you now, in picking stocks of the year competitions since I was 20 years old, I've got a 90% hit rate of getting it wrong on my stock of the year.
Oh, okay.
Which is why Rockwood is a portfolio of 23 companies, and whatever. So I think. So I'm going to be slightly twee about it and say, for those that are interested in stocks, like some of the stocks that I've been talking about, or their potential, it's difficult to work out which has the best risk reward. They've all got risks. They've all got big rewards. Maybe going down a portfolio approach and looking at Rockwood might be the better idea. I'm showing that's slightly shameless, but there we go.
Yeah, no, I think you're exactly right. When you sort of like, you invest in small cap companies, they all carry high risk and high reward. And if you go for a concentrated strategy, you can be wrong on one or wrong on two, but over the portfolio of 20, you probably find sort of like 4 are absolutely brilliant stars, do really well. The majority sort of like make you a bit of money, but not your sort of your 15%. And then you have a 2 or 3 which go the wrong way. But overall, your portfolio delivers fabulous returns. So you're probably right. You need to take a more diversified strategy.
I think you're absolutely right, and I think for those that are Rockwood followers and are watching this cast because they're interested in Rockwood, it isn't. We obviously have things like Funding Circle and Filtronic and RM have been great powering performance in the last 12 months. But we are getting things wrong. We are not getting hubristic. We've got things. We've talked about some of those stocks today, but from a Rockwood NAV perspective now, what I'm very comfortable saying is I can still see significant upside from those large positions that have been performing. But the ones that have been problematic we're not like, they're not sort of, we're wrong, we're cutting things like Argentex and Flowtech and say James Fisher, we now think are starting. So what you could start to get is we've sort of taken the pain, but actually shareholders haven't seen the pain because other things have been good. But those things are now going to start to deliver for the portfolio. That's the way I'm thinking it in my mind now.
Brilliant. Okay, well, again, thanks very much for your terrific insights and comments today, Richard, and very much look forward in seeing how the portfolio returns, and also touching base again in about 6 months' time. So thanks again, Richard.
Thanks for having me on, Paul. Always a pleasure.